Hello, everybody. Welcome to Zoe's Treasures. My name's Tracy, and as always, here with my husband, Noel. And welcome, Friday Night Tax Talk. We have an exciting topic to talk about. I know I say that all the time, but all of this is exciting to me. I know. Taxes on a Friday probably is not the most exciting thing to everybody else. And we kind of have no Southern charm. We kind of actually covered this, I think, last week. I do quite a few talk shows, so I'm not exactly sure what show we covered this in, but we did talk a little bit about this. We're going to kind of come at it from a different way tonight. Before we get started with that, exciting taxes, I know. Before we get started, we're only going to be here about an hour tonight. I have a raid train at 8:20, so I plan on doing this show till about 8 o'clock. Then we're going to raid. Give me a minute to kind of reset and get ready for my raid train I'm going to be in. But it is the Southwest Decor raid train. If any of you love that Southwest kind of cowboy type decor, not really farmhousey, more of the cowboy type stuff, I have quite a bit. Do you? Well, check it out. Everything behind me is going to be in this raid train, and I'm going to be back on at 8:20 for the 20-minute spot. So don't miss it. Stay tuned. Hang out for this one. Go take a little break and come on back at 8:20. But that's tonight. And then tomorrow morning, I'm doing glowy glass. I was just right before this going through all the glass, getting it all ready to put on the shelves after the raid train. So we have about 65 pieces or so of glass, and every single piece glows. That's at 8 o'clock tomorrow morning, 8 a.m. Eastern time. And everything starts at $1. Shipping is $4.50. So if you like glowy glass, once a month, we bring it and give you a chance to grab some good glowy glass. Tonight, we're going to be talking about cash versus accrual accounting. And there's a really big reason why this is important. Hello, Kate, not only in accounting in general, but why it's important to you as a reseller. And I'm going to show that to you in just a second here. I'm waiting for, see if my husband has the form ready. You have it ready? Okay. So let's talk about why cash versus accrual accounting is important to you. Can we bring up that Schedule C? All of us as resellers have to fill out what we call a Schedule C if you are not incorporated as an LLC, a multi-member LLC. So this is a form most of us fill out on our tax return. We attach it to our 1040 tax return. And I want to bring your attention to line F, right up there at the very top. We'll zoom in. One of the questions you have to answer is your accounting method. And if we scroll over, the IRS is asking you to say, are you cash? Are you accrual? Are you other? Don't worry about other. That's really, really rare that you would ever pick that. But you do have to pick if you are cash or if you are accrual. So let's talk about what does that mean, cash or accrual. Thank you for showing that. So we have two different things when we talk about cash or accrual. It goes back to a basic accounting concept. So it goes back to what we consider GAAP accounting, generally accepted accounting principles, and the basic concept of cash, where we're tracking the movement of cash, or accrual, where we're matching up the actual revenue and the expense together. So we're going to go through kind of piece by piece, understand why it's important, why what you pick is important, and what happens if you don't pick the right one, and how to change it on your tax return. How do we go from our accounting records to our tax return, knowing the difference between those two? Before we start that, I am going to pin this up here. I do want to talk about this really quick. I don't talk about the things I sell a whole lot, but I am going to pin this one. This is our Live Seller Collection Library. This is a really great library of resources. We have PDF guides. We have Excel templates in there. But more importantly, one of the things we add in there every single Friday are the business notes from this morning. So at 7 a.m. every Friday, I do a business talk, and then we do the tax talk. So the notes from the morning session and the evening session. Today I have about 7 pages for this one. Those are all put in there for you to access for as long as you want to. So we continually add to that library week after week after week. And as I develop anything else as far as templates or tools, they go in there too. So it's a one-time purchase and you get access to everything. We have over 40 documents in there right now, and it continues to grow every week. So I'm going to leave that up there on the bottom. Is it a video or just sound? So the Live Seller Collection Library are actual, there are no videos in there, but they're actual guides. So there's PDFs, there's checklists, there's Excel templates, there's information, just pages of information on a whole variety of topics that would be of interest to resellers. And then the notes from the shows, they tie back to the videos we have on YouTube. So the shows we do on Friday are always on YouTube, and the notes for those shows are in that library, so you can match them up. If you hear me talking about something, you can see the notes and actually see the examples in writing. So I'm going to leave that there, and I'm going to keep talking here. So let's talk about, first of all, let me ask you a question. And you don't have to give me numbers. Do you currently track your income and expenses, like on a regular basis? So does everybody here track their income and their expenses? Not just a bank account, but either through pen and paper, some type of spreadsheet, some type of computer program. Yes, no, yes, okay. Nope, maybe, yeah, Southern Charm, yes. All right, we're about half and half here. So only 4 of you answered, that's okay. We're 50-50. Let's talk about why it's important to track those. Just understanding your business to begin with, knowing where you've been and where you're going. You're not screwed because now that you know that you don't, you just stop and start doing it. So you can always start. If you realize you're not doing it, you can always start. So let's talk about cash a little bit. Cash, when we're looking at a difference between cash and accrual accounting, cash just is tracking when the money moves. So it's tracking that movement of money coming in and money going out. So cash basis records the income the minute you receive it. So the minute that cash gets in your hand, that's money you've earned. Not before, not after. It's physically that acceptance of the cash or the spending of the cash. That's your cash method. It really tracks what you know. What I want to make a really good important point here is that most resellers default and they use the cash method because it's familiar to us. We're used to saying, hey, when there's a deposit put into my bank, that's my money. I received money, now it's mine, right? When I go to the store and I spend money, money is left my ownership and it's gone to somebody else. So money in, money out. That's how we think and operate in day-to-day life. So when we start a business, we just tend to default to tracking our income and our expenses in the same manner, which is cash accounting. So you're already probably doing cash accounting, even if you didn't realize, hey, this is what it's called, this is the proper accounting term for it, is cash accounting. You're probably already doing it. So knowing that you're already doing it, that's one less thing that you actually have to learn. You already know it. What I'm going to talk about is a little bit more of the specifics of it and how that's different from accrual accounting. If you're just joining, we're talking about cash versus accrual accounting, and why that's important to you as a reseller is because on your tax return, one of the very first questions you have to answer and tell the IRS is what type of accounting you're doing. And once you make that choice, you're kind of stuck with it. You can change it. I'll tell you in a little bit how to change it, but it's not easy. So it's a very important choice that you are making, particularly in that first year of business, because you don't want to take the wrong one. It can also mean the difference between a lot of tax liability and a little bit of tax liability. So we've already established that the cash method is the most intuitive one because we're already kind of doing that. So what about the receipt from whatnot and then the receipt on sales for lost profit? Okay, hold on. Let me try to understand what you're asking. So what about the receipt from whatnot and then the receipt on the sales for lost profit? So you get a receipt from whatnot. Are you talking from a seller's perspective? So money earned from a seller's perspective, for when we're talking cash, accounting, just when you had that sale, you do an auction today. So today is Friday, you do an auction. You get an email from whatnot afterwards saying, hey, you made this much money. If you're doing cash accounting, you don't record it then. You didn't really earn money on Friday. You'll earn money on Monday when that money goes into your bank. So if I do a show today, my favorite subject too. If I do a show today and I go ahead and do all my shipping labels, I pack my boxes and everything's done on my side, and then I see that money sitting there available for me, and I tell whatnot, hey, go ahead and give me my money. It's not mine until it shows up in my bank under cash accounting. So if we're talking cash accounting, it's when you physically have that money in your hand or in your bank available to you. Now, when we're talking about spending money under cash accounting, it's when you physically spend the money. So when you're on whatnot and you swipe and you buy something and immediately they take the money out of your account, immediately. That's cash accounting. You record that as an expense. But what about, let's see, what about if you placed an order for something and it wasn't shipped yet, and they don't actually take the money out for 2 weeks? It's not considered, you don't record that under cash until they physically take the money out of your bank. When you first order something online or order something from a company and you just place the order, under cash accounting, that doesn't mean anything. It only means something when that vendor takes the money from your bank. Under cash accounting, we are tracking the actual physical movement of when you receive and when you spend cash in the moment that it happens. That's cash accounting. That's when you can record it in your books. Any other time, it's like it didn't exist. It's like it never even happened. And for most of us here, that's what we default to, and that's okay. But understanding that that's what we're doing, then we can logically say, all right, I understand that, yes, I am doing cash accounting, so I should be marking cash on my tax return. Kind of think of it like this. Here's kind of like an analogy to think about it. How many people here use their bank statements or looking at your bank online as kind of your record of what's happening in your business? We had a couple people say they don't track it. They don't track their income and expenses. But I can probably guess that most people will, I don't have my phone with me, will pull up their phone and they use their bank, the money moving in and out of their bank, as their tracking mechanism. Yep. Okay. So that's pretty common. It's not the best way. You still need a separate bookkeeping system. That's just your bank account. But an analogy for cash accounting or a credit card, whichever, an analogy for cash accounting is kind of like watching it in your bank. If the money's there, it's yours. If the money's not there, it's not yours, right? That's cash accounting in a nutshell. Most of us just intuitively go to this. So since we're already doing this, it's a natural kind of progression to use the cash accounting. Perfect. I love that. That's the next step. Junk and texting, that's the next step. So it's great that you're tracking your bank. That's wonderful. I applaud everybody for taking the initiative to look at your bank on a regular basis. But the next step is to actually track 3 important things, either on a pencil and paper, a spreadsheet, or some type of accounting software. Money coming in, money going out, and your inventory. Those are the 3 things you should be tracking. And for the cash basis accounting, you're tracking that when it happens. So it's pretty real life, right? It's just as you're doing it, you're tracking it. I was on a sale averse person, but then I started buying too much. Yeah. If you guys say, and I love the conversation, I am also doing what I'm calling the Setting Up Your Reselling Business workshops on Monday evenings at 7 p.m. And we just finished taking 2 weeks to talk about setting up your accounting system, setting up your bank account, setting up your inventory system. And then this Monday, we're going to be talking about your first couple of shows. So if you haven't seen that, come Monday. We also have it for sale in the bin, but it's been a really good workshop. But we talk about how are we setting this up? How do we maintain it? What kind of habits do we need to have to make sure we're staying on top of it? I want to make this point here. Most of you are going to be like, Tracy, if I made $32 million, I'd be thrilled. The IRS gives us a choice, right? It says we can use cash or we can use accrual. We haven't talked about what accrual means. Now, the IRS says you can only use cash if you are a small business. Okay, I'm a small business. Surprisingly, do you know what the IRS deems a small business? If you make less than $32 million a year. That sounds like a pretty darn big business to me, but as long as we are making less than $32 million, don't worry, IRS, I'm not even close to exceeding that. We can be considered a small business, and we can check that box on our tax return that says we are using the cash method of accounting. Okay. Now I'm gonna throw a wrench in here. I'm gonna just throw something in here, and we can talk about it in just a little bit. So at the top of that Schedule C, can we bring the Schedule C up again? Does making less mean sales or sales minus inventory cost? So we're going to look at the Schedule C, and what you have to put in on your Schedule C. If you see that Part 1, Line 1, gross receipts, that's everything you make. That's total sales. Then from there, you start to deduct your inventory cost, your cost of goods, and the cost of everything else. But I want to go back up to the top here really quick. So what we're really focused on right now is line F, where it says accounting method. We just went over that. You have to pick cash or accrual. What they're talking about on this line is your overall accounting. Everything I was just telling you about, the cash in, the cash out. That's what line F is talking about. How are you doing your day-to-day bookkeeping, cash or accrual? If you pick cash here, which most of you will, that's totally cool. But then you can scroll down, possibly page 2. Can you scroll to page 2 for me? Right there, stop. Then it's going to ask you, how are we doing our method of accounting for our inventory? Line 33. If you scroll over, so method used to value your inventory, we have cost. Nope, that's it. I'm sorry. Scroll back out a little bit. I thought it was going to give us a choice here. Nope, it's actually, sorry, keep going back over. I can't. I don't have control of this, you guys, so I'm trying to tell my husband to go back and forth. All right, I'm not going to confuse you. We're going to pull back out for a second. I'm going to tell you in a minute. Let's close this one. When we talk about taxes here, this is the monkey wrench that I'm going to throw in here. Christy, I see your question. I'll get to it. Just one second. I'm going to throw you a monkey wrench. Well, we pick cash for our on line F on our Schedule C. When we go to inventory, we actually should be doing accrual on inventory. So in the big picture of things on our Schedule C for our accounting, most of us are doing cash, but when it comes to inventory, we do inventory the majority of the time under accrual accounting. I'm going to tell you what that is in just a second. If we have cattle and farm and a regular job, so I normally do our taxes and then give it to the accountant, how do I mix my stuff now with that? That would be completely separate. So a farm, I think it goes on a Schedule F. I'd have to double check it. It's been a while since I looked. So farming income and expenses are a different schedule than Schedule C. A Schedule C would be for your reselling business. I'm pretty sure it's an F. Schedule would be for your farming business. Those are two completely different things. In addition, you may have multiple Schedule Cs on one tax return. You may have a Schedule C for your reselling business, reselling meaning Whatnot, eBay, Macari, all of those fall under that reselling bucket or umbrella. But what if, is it scheduled? I thought it was. It's just been a while since I've looked at it. What if you also do Uber Eats? So if you're doing Uber Eats and you're doing reselling, those are two separate businesses. You would have two Schedule Cs on your tax return. So when I'm talking Schedule C here, I'm talking about just the umbrella that covers your reselling portion of it. It is on YouTube. So this one will be on YouTube, so you can always go there and rewatch it. Also, if you're more of a, I like to see it in print and read it type person, that listing down below gives you access to a bunch of different guides, but in addition, every Friday, all of my notes from my Friday talk shows go into that library. So you always have access to all of my Friday show notes. Okay, so now that we understand cash, we know what cash accounting is. That's just when you get the money, when you spend the money, just like we live in real life. We're used to it. We know it. Just instinctively, that's what we do. Let's talk about the other one. Let's talk about accrual, because that's the other choice that the IRS gives you on your tax return. You're very welcome. So accrual records the income when it's earned, meaning when the sale happens, and records the expense when it's incurred, regardless of when cash changes hands. So cash is when it's actually happening. That's cash accounting. Accrual accounting could care less about when you get that money or not. Has nothing at all to do when the cash is coming in or out. Accrual accounting has to do with when you actually earn the money and when you actually incur an expense. Let's dig into that a little bit. When we talked about cash accounting, we talked about you doing a Whatnot show. If I do a show under cash accounting on Friday night, there's nothing that I don't get my cash on Friday night. I do all my shipping, my packing, my funds become available and Whatnot. I tell Whatnot to put them in my bank. The minute those funds hit my bank, which is usually Monday or Tuesday, that's when that becomes my money. That's when I record it under cash. Now let's look at that same scenario under accrual. So under accrual accounting, I'm a Whatnot seller. I do my show on Friday night. The show ends. I get that email from Whatnot that says, congratulations, you made $2,000. Guess what? That's when I record it in my books under accrual. I have earned money. I don't see the cash yet. It's not in my bank. But under accrual accounting, it's my money, and I record it in my books the minute I earn it. Right? So there's a big difference. We're talking days difference on when that money actually goes into my accounting records. So that's high level on revenue, on the difference between cash and accrual. Now, what about expenses? Let's go to cash. When I, let me think of a good example for an expense. I didn't quite write an example down. When I have an expense, let's say I call up somebody, I call up my best friend and I say, hey, I know you have all this vintage decor. I'd love to buy it off of you. And she's like, yeah, girl, I'm going out of business. This is wonderful. Go ahead. Deal's done. I'm going to put it in a box and ship it to you. When you get it, go ahead and send me a check. Because it's your best friend. She trusts you, right? Under cash accounting, nothing happens until I get the stuff and I actually physically write the check or do the Venmo. Let's get in this day and age. Till I actually get all the stuff and I Venmo her some money. When I do that Venmo, that's when I record the expense under cash. Under accrual, I record the expense the minute I get off that phone with her. The minute I say, hey girl, you're going out of business. I want to buy all your vintage decor. And she says, sure thing, no problem. I'll pack it up tomorrow. It's going to be $500. I'll send it to you. Hang up the phone. At that very moment, you have entered into a contract. You have entered into an arrangement to spend money. You have accrued an expense. And it becomes a bookkeeping entry for you immediately. Even though you haven't Venmo'd her yet, even though it may take 2 weeks for you to receive the items, it doesn't matter. You accrued the expense right then and there the minute you entered into that contract. So if we document date ordered in our Excel sheet, what is that type? If the date you ordered it, if you didn't pay for it and you're using that, you are doing accrual accounting. That's accrual accounting. If you are waiting and you're recording it the minute the cash leaves your bank, it's at the exact same time that the cash is coming or going, that's cash accounting. Farming is prepay, so that's accrual. The prepay concept is part of accrual accounting. So you're prepaying for something. You're actually creating an asset, like an asset that you have that you would record when the bill comes in. So that falls under the accrual umbrella. Why is this important? You're like, okay, this sounds really confusing, Tracy. I don't need to know about accrual. I'm just going to do cash. To heck with the other methods. This becomes really important, one, for tax purposes. We said that you've got to pick one or the other on your tax return. I want you to think about this concept. How many of you see an uptick in your shows around Christmas time? People are spending. If they're spending at Christmas, you're going to take advantage of it and you do more shows in December, the last part of December. Not really tax bracket. So if you're one of those people that are like, hey, I'm selling a lot at the end of December. Think about if you're doing cash accounting and you do a show on December 29, 30, 31, when logically are you shipping that out? Depending if it falls on a Friday or Saturday. Probably not until, the following year, January 1st, 2nd, just depending on what part of the week it falls in, right? If you're doing cash accounting, that money you earned from those shows doesn't fall in the first year, it falls in the subsequent year. That means for tax purposes, you're not taxed on it in this year, you're taxed on it when you get it in the subsequent year, not when you earn it. However, if you're over here and you're doing accrual accounting, that goes onto your records. If you check that box on your tax return that says, I'm doing accrual accounting, even if Whatnot hasn't sent you that money yet, you got to pay taxes on it still. So the timing matters. The difference in timing could be a few days, and it can really make a difference on the expenses and the income that you're claiming on your tax return. What if we receive the money and Whatnot, but don't transfer it to the bank account? So technically the money and Whatnot is your money. It's an asset, only under accrual accounting. It is, if you're doing cash accounting, it's not your money until it gets into your bank. While it's in a whatnot account under your name for cash accounting, as far as the IRS is concerned, if you check that box and you're doing cash accounting, that is not yours until it goes to your bank. If you're doing accrual accounting, every dime sitting in whatnot under your name is your income. Yes, cash accounting is just like what you're used to and how you spend money. I record it when I get it. I record it when I spend it. You don't have to remember timing and everything else. But here's the kicker. When you go to get a loan from a bank, if you want to get a partner on an LLC, maybe you're not looking at a business loan, but whatnot's your full-time gig, and you and your spouse decide to buy a house, and you're like, hey, I'm making good money at whatnot. I want to use my small business income as part of this loan application, this mortgage application to get this house, because part of my money is going to pay for this house. If any of those things are happening that involve an outside lender, an outside investor of some sort, you know what they're going to want? Audited financial statements. They're going to want financial statements done under GAAP accounting. Thank you, Crystals, for the raid.
Welcome in, Raiders. Glad you can join us on this business and tax discussion.
Thank you, Crystals, for bringing everybody over. I hope you had a wonderful show. If you came with Crystals, my name's Tracy. This is Zoe's Treasures. We are talking the difference between cash and accrual accounting and why that matters to you, why it's important. Crystals, while I'm talking, please put in there, you know the drill, what you do, who you are, what you sell, any other thing you want people to know about you. Please throw that in the box so that everybody here can click on you and bookmark some of your shows and give you a follow. Okay, so when we're looking at the difference between cash and accrual, you're like, hey, heck with that. I'm just going to do cash. It's easier. I'm with you. I don't blame you. And that's what I would recommend to you 9 times out of 10 as a CPA. However, if you get to the point where you're using your income as proof that you can repay something, you're going to buy a new car, you're going to get a mortgage, you need a small business loan, maybe you want to partner with somebody, maybe you want to enter into some type of rental agreement that wants some financial statements. Those all have to be done under what we call generally accepted accounting procedures, which is GAAP, and that's accrual accounting. So at this point, it becomes really important to you to understand the difference between cash and accrual and where you may be going in your business. So now we have 2 choices here, okay? Cash and accrual. But I want you to separate this out because we have accounting, we have what we do as business owners day to day to day, and you can do it on either cash or accrual. Then we have taxes, okay? 2 completely different things. You make that same choice of cash or accrual on both items. So let's say you're in business, you're doing your thing, and you're doing cash accounting because that's the easiest. I don't blame you. That's what we probably should be doing as a small business. So you're doing cash accounting. And then you get to your tax return, you pick cash again. Or you can pick accrual. You can do it in a different manner if it works better for you for tax purposes. That's where you need to get a CPA to help kind of guide you through it. Now we get to the point and it says, hey, I need to switch my books over to accrual because I want to get this loan and they're telling me this is how it has to be. That's fine. Totally easy to switch your books. You could be doing accrual accounting because you know you're applying for loans. You have business in a way that requires that and still do cash on your tax return. So you have that choice of cash or accrual, both for your books and for your tax return, and they don't have to be the same choice. Sounds a little confusing. The majority of you will be doing cash on your books, cash on your tax return. But understanding what accrual is, because if you go to the bank and you're like, hey, I want to get a new car, I've been banking with you for 10 years, let me fill out this application, this loan application to get a new car, and you put down, I'm a reseller, I have a small business, this is my income, I make, $80,000 a year from whatnot. The bank's going to say, cool, dude, where's your financial statements? And you're going to be like, oh, what are you talking about? Here's my cash basis financial statements. And the bank's going to be like, no, we don't accept cash basis. We need accrual basis. So as a business owner, it's okay to default to cash, but making sure that you understand that so that you're speaking the same language, so that you know, hey, I'm not doing this. And before I start entering into these loans, maybe I need to go talk to a CPA and help figure this out. So hollow leg salvage, I'm assuming what you're talking about, the 3-year rule. This is a common thing that we hear. There's crystals. Um, it's a common thing you hear when it has nothing to do with cash or accrual accounting. What it has to do with determining if you're a hobby or a business, and it's actually a fallacy. So there really isn't such a thing as a 3-year rule. What that refers to, when you hear people talking about this a lot, they're like, oh, you have to make a profit within the first 3 years, yada, yada, yada. There is a safe harbor within the IRS that says if you make a profit 2 out of 5 years, so basically within a 3-year period, we'll consider you, we'll safe harbor you into a business. They won't automatically assume that you're a hobby. It's like this IRS safeguard that they have, safe harbor rule. So I'm not saying I hate that you brought it up, but that is thrown out there so often that it's a misconception that you have to make money within 3 years in order to be considered a business, and that's not true. There's a whole lot of there's 9 separate rules that the IRS looks at to determine if you're a hobby or a business. That's just a safe harbor rule, and it's taken out of context tremendously by people who don't really know what they're talking about. Okay, so we talked about cash and accrual, the difference between the two, why it's important to you. 2 big reasons. You have to check that box on your tax return, and you have to kind of understand that when you're going out and looking at these things that do happen. You may be sitting there saying, I'm nowhere near taking out a bank loan. I don't even need to consider this. Maybe not today, but what about 2 or 3 years down the road? You don't need to be making, millions of dollars at this to want to buy a car, to maybe purchase a house and want to use this income to support that. So making sure that you understand that. Let's talk about what happens. What happens if you're like, oh man, Tracy, last year was my first year in business and I just checked accrual because I didn't know what I was talking about. I just picked one on that Schedule C, and now I'm like scared. Now I don't know what to do. Don't panic. The basic rule is once you pick cash or accrual on your tax return, you have to stick with it. You really can't be changing it. The IRS doesn't like changes. They're like, no, we're not going back and forth. You pick it, you stick with it. Now, if you really made a mistake, or maybe you've been doing cash for a long time, now your business has grown, you've switched to accrual, and your CPA says, no, we need to make this everything in line and accrual. So maybe you're just at that point. There is a form. It's form 3115, I think it is. No need to bring it up. And not that you need to remember the number. If you ever get there, all you have to do is Google it and you'll get the form number. But if you make a mistake on what you pick, or you ever want to change your mind, you actually have to fill out this form and ask permission from the IRS to change your method of accounting. It's kind of a pain in the butt. So this is why I like to talk about it up front, so we understand it going in, so we pick the right thing, and we save ourselves a little bit of a headache from having to change. If you've been doing cash and your business is going along, it's growing, it's doing great, you get to the point and you get a CPA, and the CPA is like, hey, we need to switch everything to accrual. If you're at the point of hiring a CPA, they'll help you through that. They will do most of that for you, but it's good that you at least have some awareness of what's going on. Then you do not have to amend your taxes, because your taxes are valid until you get the approval from the IRS that you're allowed to switch. All those prior years stay in the method. So if I've paid cash over years, those stay as cash. And then once the IRS tells me and approves my application to switch, then that tax year is switched to the new way. And that's either way. That's if you start as accrual and want to go to cash, or if you start as cash and want to go to accrual. The process is the same way to switch it. Do you have to fill out a form for top or bottom portion? Top or bottom portion? Help me out there. What are you asking? I'm not exactly sure what you're referring to. But if you give me a little more information, I can probably figure it out. On the Schedule C, do you have to fill out a form for the top or bottom? Let's pull up a Schedule C and take a quick look at the Schedule C. Can you bring that back up for me? This is your Schedule C that you fill out. The very first section, let's zoom into that top part. It is rows A through J. This is all your basic information. A through J is telling the IRS, and the top and the bottom is inventory. Correct, yes, you do have to fill out the inventory. So I'll show you where that's at here and what you have to fill out. So A through J, That's your basic information, who you are, how you're doing your accounting, when you started your business, all the basics, right? Did you actually participate in this business? Then part 1, rows 1 through 7, is your income. This is your income and then your cost of goods. The cost of goods actually comes from that inventory section that you're referring to. So part 1 is telling the IRS how much gross money I made, how much refunds I had to give, and then how much my cost of goods was, and what is my gross income after that. So what is my gross profit at that point before everything else. Then we get to part 2. Part 2 is everything else. These are all those other expenses we talk about all the time. Your shipping supplies, your home office expenses, your travel expenses, all of that good stuff that we talk about. That's all in that part 2. Then we go down a little bit further, and rows 28 through 32 is talking about your home office. So this is where we get to deduct some of our home office expenses. And then we go down to part 3. This is probably the bottom portion you were talking about. This is your cost of goods sold. This is where I was saying earlier that even if you do cash, if you pick cash at the top of this form, when we get to this part, when we get to the cost of goods sold, that is legitimately, yes, the cost of the goods that you sold. Just like it says, cost of goods sold. This isn't what you bought to sell. It's not what's in your inventory. It's what you actually sold. And that's accrual accounting. So we're actually filling out part 3 under accrual, even if at the top we picked cash. Sounds a little confusing. Row 33 is the method you use to value that cost of goods sold. So the choices you have is cost, what you actually paid for it. 99% of the time you're picking cost. We have lower of cost or market, more into like manufacturing and stuff. As a reseller, you're probably not picking lower cost of market. And then we have other, which are even more unique circumstances that I'm not even going to go into here. It's probably not, that's the choice that probably none of us would ever even pick. Good evening, Eve Jack Peace. And if we get audited, we need receipts to back up those cost of goods, correct? Even if we bundled and didn't itemize them, correct. You do not have to itemize your inventory. Keeping a good inventory log and the receipts when you purchase inventory is all you need to do. And that inventory log does not have to be item by item. It can be on averages in bulk. What is the benefit for using accrual at first? So accrual accounting is the generally accepted way of doing accounting. That is the correct method of doing accounting. So as an accountant, as a CPA, I would never choose cash for myself because I grew up in the profession doing everything under accrual. Accrual, it falls under what we call GAAP, which is an acronym for Generally Accepted Accounting Principles. That's just what's accepted as the standard of accounting is accrual. And accrual actually matches up the revenue and the expense in the same period that they're earned, where cash accounting doesn't always do that. What do I mean by that? Let me give you an example that we've been using of doing a whatnot show. If I do a whatnot show under accrual accounting, I do my show, the show ends, I get that email from whatnot that says you earned $2,000. I immediately earn $2,000. That goes into my books. That is my $2,000. Even if I don't have any cash in my hand, I've earned it. I also, at that very moment, record the cost of goods sold. So maybe I spent $500 on my cost of goods sold. I earned $2,000. I am matching up the expense of the goods with the revenue of the goods immediately. Has zero to do with the movement of the cash. That's accrual accounting. It gives you a truer picture of your books. It gives you better data to make decisions from, and a more accurate portrayal of what's happening in your business. Whereas cash is the movement of money. It's following that movement. It doesn't tell you, so when I'm doing my cash accounting, I'll have the inventory expense, I'll have that cost of goods expense that I record when I purchase that, not when I sell it. So it's a very different, the timing is all screwed up. You cannot look, if you're doing cash accounting, you can't truly look at everything that happened in January and say this is January's expenses and revenue, because you can have some from the prior month. It's all messed up. You can have stuff that you bought that's not happening till the next month. So it doesn't match the earning of the revenue and the expense it takes to earn it together in the same period. So purchase items years before started reselling, can I claim as an expense or only profit? No, you actually put that into your inventory. So when you started your business, whatever those items were that you accumulated, you would put those into your inventory. So you would do like an owner's investment. That would be your beginning inventory at the cost that you purchased it at whatever time you purchased it. The safest and smartest is accrual. As a CPA, I say yes, the safest and smartest is accrual. However, accrual is a concept that in general is not intuitive. It's not easy to follow. You have to have some accounting experience to do it and do it correctly. So the default for the majority of people is cash, and that's okay. If you're not creating detailed financial statements, if you're really just basing it off of broad year over year, this is how much I made, or quarter over quarter, this is how much I made, this is how much I spent, that's okay. For the majority of small businesses on whatnot, cash is just fine. As we get going with our business and we need to do more analytics and really start looking at it at deeper levels, that's when accrual really starts to play an important role. It also plays an important role when you need to get loans, when you need to create financial statements to use for outside purposes. But if you're just using financials that you create under cash for your own purposes, you can still make good decisions off of those, and that's okay. So if we have inventory left at the end of the year, we do accrual, and how do we carry that in our account? So say you're doing cash. You're just recording money as it comes or goes. We're good. Come the end of the year, you do your tax return. You pick cash at the top, you record all the money that came in, all the money that you spent that went out. When you get to that inventory section, that cost of goods section, you are only recording the actual goods you sold. So you're not recording, I bought all this inventory, I'm going to just expense all this inventory. So if you bought $10,000 of inventory during the year, but you only sold $3,000 of it, $3,000 is your cost of goods that goes on there, not the full $10,000. And then you have $7,000 left that will end up being an expense in future years as you sell that inventory off. Self-employment tax thoughts. I only know farming with town job. Thank you. That's what I thought accrual was going to work best for me overall. Perfect. Self-employment tax thoughts. I only know farming with town job. Okay, so self-employment tax. Crick and Nix, I'll get to that in 1 second. The IRS is a pay-as-you-go system. When you work for somebody else, your employer takes out the Social Security and Medicare tax and withholding from your paychecks. You don't have to worry about it. They take it out. They remit it to the IRS on your behalf. Well, when you're working for yourself, there's nobody taking that out for you. So you're responsible to pay in that in the form of what we call estimated tax payments. 4 times a year, you pay once a quarter your estimated tax payments. Now, there's some rules around estimated tax payments. I do suggest in there, in that library down there, I have a full estimated tax guide that kind of walks you through various scenarios and how to figure them out. But the basic rule of thumb is the IRS says that when you're working for yourself, you need to pay in 100% of what you paid in last year. Normally, when you have a W-2 job, that's not a big issue. You pay it in through your W-2 job. When you're working for yourself, that becomes your responsibility. So you need to understand how much you paid in last year. And then they also say, if you expect your tax liability to be $1,000 or more than what you had last year, we also want the extra. You can't just be safe by paying in last year's. We need that extra too, if it's $1,000 or more in liability. So let me go back up and answer this other question, then I'll get down. So we did that one. Okay, so if IRS will let me use the receipts for next year for leftover inventory, absolutely, absolutely. Because you're not expensing it in the year you bought it. You expense it in the year you sell it. Because until you sell it, it's an asset. It's something you own. It's just sitting in your possession. Inventory, you guys, inventory is literally cash sitting on a shelf. This is why inventory management is so vitally important. I did a 2-hour show on this the Friday before last, I think it was, where we talked, was it Friday? I think it was a Friday before last, maybe it was Wednesday. It's on my YouTube where I spent 2 hours talking nothing about how important your inventory management is, because it is literally, I'm not being like dramatic here. You're taking cash out of your bank, you're exchanging it for a product that's sitting on your shelf. That's cash sitting on your shelf. If you are not managing your inventory, turning over your inventory, that is no different than just putting cash away in a drawer. It's just sitting there doing nothing for you. So that's actually what that inventory is cash sitting there. Lost inventory, if you're talking like obsolete or inventory, you're talking lost. I'm assuming when you say lost, it's stuff you put in a tub and shove over in the corner and forget about. Is that what you mean with lost inventory? I'll give you a chance to answer that. Oh, stolen inventory. So stolen inventory is a little bit different. That becomes an expense immediately because it's no longer in your possession. So it's no longer an asset that you own. So it becomes an expense at that point. So that's a little bit different. That is treated as if you sold it. You get to take the expense at that time. So I want to talk about consistency in this. And I know we talk about consistency in everything. You guys, it's the magic word in life. It's a magic word on whatnot. Consistency in how you're doing your accounting, cash or accrual, is vitally important. If you do cash 1 month and then you decide, oh, Tracy talked about this thing called accrual, I'm going to switch to accrual. And then you're like, man, this is hard. I don't like it. I'm going to switch back to cash. Those 3 months are not comparable. You're no longer comparing apples to apples. You're comparing an apple to an orange to a grapefruit at that point because it's so convoluted and so messed up. Consistency is key in your bookkeeping and the method you pick, cash or accrual, just as consistency is key in everything else that we talk about on whatnot. And to even drive that point home further on how much consistency matters, I go back to the point of the IRS just doesn't let you change on a whim neither. You actually have to ask permission in order to change that on your tax return. So understanding it, getting your feet on the ground, picking what you're doing and keeping consistent with it is very important. One, for you to be able to make decisions and compare apples to apples when you're looking over your records, and then also for tax purposes. We have about 15 minutes left, you guys, before I have to go because I have a raid train tonight. So if you have questions, throw them in there so I can try to get to them and answer before 8 o'clock. 10 minutes. my timekeeper's over here going, you have 10, you don't have 15. I want to give you an analogy here on being consistent with your method of accounting. If you get on a scale, you say you're trying to lose weight or maybe you're trying to gain muscle, one or the other, and you have a scale in your bathroom and you use it all the time, and you're tracking and you're monitoring and you're down to that little ounce and you're watching. And then you do this for 5 or 6 months and then you go to the gym and you jump on their scale and it's vastly different, or you go to the doctor's office and you're like, dude, your scale is screwed because I weigh 10 pounds less than that at home, right? That's what it's like when you switch your accounting methods up. Everything gets out of whack. So, inconsistency, I got a stat here from some research. Inconsistency in bookkeeping method is one of the most common reasons small business financial statements cannot be used for loan applications, investor conversations, or accurate tax filing. The number itself matters less than the reliability of how it's measured. So let me reinforce that again. Inconsistency in bookkeeping is the number one reason why banks, investors, and how you get in trouble on taxes, why none of that can be used, why it causes hardships to be used in there, is because you're not being consistent within the way that you're doing it. It's really important. I know I'm the crazy one constantly spouting taxes and bookkeeping, but it's vital to your business. The whole reason you are here is to make money. You should be protecting that through your bookkeeping. Do you set aside for taxes each show items month? Which is easier? That really depends on your situation, but I would do it on a monthly basis at a bare minimum. I would look at my net profit for the month. Again, you can't do your net profit if you're not doing your bookkeeping. I would look at my net profit and put aside around 18% if you're employed for somebody else and paying in that way, or around 28% if this is your full-time gig. And those are just general numbers. They're not going to be exactly on point for every individual situation. They are a general guide that should get you pretty close to where you need to be. We list our income immediately and log money spent immediately, but inventory doesn't all sell. How do you divide that? So you should be keeping your inventory on a separate ledger. So the money that you spend when you're doing cash, the money that you spend is coming in and out. You're recording that. However, your inventory, you should also be keeping an inventory log based on what you're spending and what you're selling. So you have 3 types of records. You have money in, money out, and inventory. The inventory is beginning inventory plus everything you bought minus everything you sold equals your ending inventory. So when you go to do your tax return, you're pulling out that inventory part. So that's not part of your expenses. When you do your expenses, you should be categorizing your expenses. So every time, no matter what you use, pencil and paper, accounting program, whatever, when you do an expense, you should write the date, who you bought it from, a really short little description of what it was. It was shipping, supplies, whatever it may be, and then a category. The category is, I bought inventory, I bought shipping supplies, software for the business. There should be about 8 or 9 common categories that you spend money in. That's how you classify your expenses. So when you go to do your tax return, it should be very easy to look at your books and say, oh, here's all the money I spent on inventory. Well, I'm going to pull that out because I know that's not truly an expense. I'm going to now go look at my inventory record and look at my cost of goods, what went out, and that's my expense that goes on my tax return. So I bought 20 items in a estate sale and 18 sold. Should I carry the 2 to? Yeah, absolutely. Absolutely. You just record the cost of goods for the 18 that sold. And the other 2 are just sitting as an asset, just sitting there. So it's like you're keeping 3 separate ledgers. You're keeping your revenue, you're tracking that, you're tracking your expenses, and then you're tracking your inventory. Those 3 things, even if you're not super precise, and if you just have 3 notebooks, and one's your revenue notebook, one's your expense notebook, and one's your inventory notebook, while it may not be super pretty and super easy to create reports or anything like that, at least you have the information you need that you can sit down and spend time with to figure out net profit and the stuff you need for taxes. So at a bare minimum, if you were just starting, that's what I would recommend. I don't think many people realize the IRS sees profit piles as assets. Correct, they do not. A lot of people think, and I'm assuming, Liz, when you say profit piles, it is all of your inventory. A lot of people think that if I buy inventory, that's an expense. It's not. And this is a huge misconception that we hear, not just on Whatnot, but in reselling in general. Perfect. I love it, Auntie Barbie. I love it. And it's good to see you, Auntie Barbie. Yes, I understand completely. Thank you. I'm so glad. Oh, thank you so much. I'm glad that you found me too. When I say that, when somebody says, I'm glad I found you, and then I'm like, I'm glad you found me too, it sounds so egotistical. I do not mean it that way. I'm just happy you're here. So here's the last thing. Choose what fits your reality, okay? I'm talking about 3 simple notebooks. If you're a techie person and you love software and you want Reseller Genie or QuickBooks, go for it. Find something that fits your reality. If you hate tech stuff and you get a fancy computer system with accounting, you're never going to use it. So if 3 notebooks works for you, if a 5 subject notebook works for you, if an Excel spreadsheet works for you, pick what's going to work for you that you're going to sit down on a regular basis and record your income, your expense, and your inventory. I had to point people to you today so much. Oh, thank you so much, Mamas. I appreciate that. Y'all, I'm in Mama's Ray Train tomorrow. So come see me at 1 o'clock tomorrow. I'm in Mama's Ray Train. Let's see if I have anything else before. We've got about 5 minutes or so left. Here's another analogy. Oh, thank you. You can ask me questions at any time. Oh, there's a request above. What did I miss? Please finish explaining what you were just talking about, re-inventory. Oh, I'm not sure where I left off. Where did I leave off with inventory? You buy inventory. I'll just kind of go through the inventory scenario. You should be keeping an inventory log, okay? On your log is your beginning inventory. Did you start with 0? Are you brand new? Or if you're not brand new, if you did this last year, go look at your last year's tax return. Your beginning number is on there. It's whatever you ended last year with. So for your inventory log, you keep what you started with, everything you bought, everything that came in at that cost that you paid for it. Then you record everything that went out, everything you sold. So when I say went out, everything you sold. So it's what I started with plus what I bought minus what I sold equals the ending inventory. The ending inventory, that number, it's a dollar number, should match If you went out there and looked at all your inventory sitting on your shelves and you added up what you paid for all of that, that's your ending inventory on your log. When you go to do your tax return, it's the outgoing. It's that whatever you sold becomes your expense on your tax return. So when you keep your expense log, so you keep your revenue log, money coming in, you keep an expense log. On your expense log, next to every single entry, every time you spend money, besides writing the date, the dollar amount spent, who you bought something from, maybe a little note, you're also adding a category to it. And if it's inventory, you're putting a little note saying this is inventory. If it's shipping supplies, the category is shipping supplies. If it's your subscription expense, I got it, thank you. You put subscriptions like Canva or Spotify or whatever. Or get an awesome accountant, that's the other key. So then when you go to do your tax return and you look at your expenses, you should be able to pick up all those ones that say inventory and add those all together, because that's inventory you spent money for and you recorded that money being spent, right? If you add all that together from your expenses, that's going to equal everything you bought on your inventory log. Because when I buy inventory, when I have inventory coming in, what I purchased, I've spent money, so it goes on my expense log as inventory, but I also record it on my inventory log as these are things I purchased to sell. So you can tie those two numbers together, right? So when you go to do your tax return, you add up all that inventory and you don't count that as an expense. You just back that out of all of your expenses. You just subtract that from your expenses. Then you look at your inventory log and what you had going out, your cost of goods. That's the expense that you take over to your tax return. One of the things I'm going to be doing this year, I'm trying to structure it all. And I know this a little in the future. You guys will hear a lot about it coming up in the new year. But I will be doing some coaching and some consulting around taxes. I cannot do taxes. I cannot get paid to do taxes. But I will be doing some one-on-one coaching and consulting for taxes. So those of you that are like, I'm not there yet. I don't want to pay a CPA. $300-400 to do my tax return. I want to do it myself, but I have questions. I will be offering like half-hour sessions or so of consulting and taxes. So keep that in the back of your mind. If that's something that you may need help with coming up in the new year. I'm in Pennsylvania. I will be putting that in my bin as we get closer. I need to kind of structure it and make sure that all the language around that is correct so that it separates it from my full-time job. I have independence issues that I need to make sure that I'm not conflicting with my job. So I'm working on it, but it will be there for the new year. Okay, you guys, I do have to wrap this up. Because I do have a raid train. So come back and see me in 20 minutes for the Southwest Decor raid train. But I'm going to be here every Friday night. And again, if you want these notes, they're in the bin down there. Is my book about taxes? It is not. My book is called Build the Business, Not Just the Show. And it takes you from the first things you need to know, how to set up, pretty much it goes through setting up your whole reselling business. It really talks about how to be a reseller, the tips, the tricks, things we talk about, a little bit of taxes. I know, thank you. A little bit of tax, a little bit of accounting, a lot about the psychology of selling, a lot about running a show, understanding customers. So it's really the business side. So my book is going to be 12 chapters long. It really digs in. On paper like this, it's about 200 pages. So once I condense that down into a softcover book format, it's going to be a pretty hefty book. That really just kind of takes you through everything you need to know to build your puzzle and all the pieces, those puzzle pieces that you need to be a good, successful reseller. When I started selling on one night, I started taking a track of mine selling. I started tracking 2 months ago. No, it's actually good. You recognize that you needed to do it. If you just started 2 months ago, what you need to do is go back and recreate the rest of the months from January forward. So, of course, I'll have signed copies. Yes. And with that, you guys, we are going to raid. I hate to cut this off soon, but I didn't do very good in my scheduling tonight, so totally my bad. I will be back Friday night, and I can't wait to see you guys then. I will be tonight, 8:20, Southwest Raid Train. Tomorrow morning, 8 a.m., Glowy Glass. And then, of course, Monday morning, we do our chat and sell, and we do taxes every Friday night. So we will see you then. Y'all have a great rest of your weekend. Who are we going to raid? I like this, and I don't have to do the raids. I just leave it on him.
The serial hobbist just finished a masterpiece. I was watching them finish, and oh my God, he's just started a new one. I'm gonna take you over there to take a peek. Ask him about the one he just finished, so you guys can see. Liz was there. I saw Liz lurking around over there. So ask him, and it's gonna blow your mind.
Throw some ducks in the chat when we get there so we can say hello. Let's go.